The reason is because the rich are nasty people. It's that simple. They're self-absorbed and greedy, and they're attached to their fortune. If a good person gets to a certain level of income, all right, we're gonna stop this right here. That was the response to somebody who asked the question, why do the rich hate paying taxes so much? Aren't they still rich? I'm going to show you in this video 10 ways that the rich don't pay income. And at the very end of this video, I'm going to share with you why I don't think you should pay income tax either. I just realized I said the rich don't pay income. I meant the rich don't pay income tax. Anyway, moving forward. Welcome back. My name is Walter Merle, the real estate mentor, and I have been traveling through this journey of building wealth and building millionaires. I'm on a mission to build 100 millionaires who are inspired to build 100 millionaires. And today I'm going to go into how the rich don't pay income tax, starting with number 1. We claim depreciation. Depreciation means anything worth something eventually is going to depreciate in value. Well, the government says if a house is worth $100,000 the day you bought it, then over the next 27 and a half years, it's going to be worth 0. So in order to claim depreciation, you're going to say $3,000 a year, essentially rounding, ends up being against your income. So if you made, let's say $100,000 this year, you actually only made $97,000. Now, real estate is not the only thing you can depreciate. You can depreciate assets in your business, just like a vehicle, like computers. There's a lot of different things that you can actually depreciate. Even in real estate, there's different levels of depreciation for carpets or flooring or roofs or utilities. There's a lot of different ways you can depreciate assets. You should talk to your tax accountant and figure out, is there something you can depreciate right now? And if you don't own an asset that you can depreciate on, you might want to go and acquire some assets. So number 2 is your Roth IRA or your 401k. Now, a traditional 401k or IRA is going to allow you to defer taxes until the end, until you finally take the money out. Whereas a Roth allows you to take the money, pay taxes today, and then defer no taxes on any gains for the rest of your life. So that is a much better strategy. If you're like me and you know you're going to continue earning more and more income over the next couple of decades, and then you're probably going to retire earning more than you were today. So it makes a lot more sense to put your money into a Roth if you're investing in paper assets. And even if you're not investing in paper assets, I got buddies who have their Roth IRAs and they take that money and they roll it into real estate. They use their self-directed Roth IRAs. It's absolutely insane because they're buying real estate assets and never paying taxes on any of the gains, any of the income. It's a fantastic model. If you can start now, start a Roth, you can put $6,000 a year. Now's a good time to do it. And what I've done is I've put my higher risk but high big opportunity stocks in that Roth. So if things go to the moon, I want it to be tax-free. Number 3 is deduct business expenses. There are a number of business expenses you can deduct if you're a business owner. So right now, if you don't have a business, you are getting robbed by the government. So you can go create a side hustle and then use anything that is used for that business, and even sometimes things that might be used in other stuff, but as long as they're used for the business, you can claim those deductions. Things like travel. I know I travel often. I'm traveling out for education, I'm traveling for business, and all of those expenses get covered and they get wiped out of my business expenses. Vehicles, office supplies, work-related education expenses, a home office, and anything that would be used or applied to your business. Even food and entertainment, if you're out with clients, can be applicable. Number 4, and I had a hard time deciding whether I was going to put this one in or not because it's so obvious in the real estate space. So many people who know this one. It's the 1031 exchange. This is just a deferred platform. It allows you to buy a house, it goes up in value, and it said when you sell it, you don't have to claim any of those taxes as long as you buy another property within 180 days of closing that sale. This is a great opportunity for people who are looking to keep leveling up. And then the big question I get is, well, when do you pay taxes? You don't, because you die first. You're supposed to just die and let that property be inherited by your heirs, and then they have a step up so that they never pay taxes. They could sell it that day, and as long as the property didn't appreciate from day 1 to the day they sold, they wouldn't pay any taxes on any gains. Number 5, and this is one I've used dozens of times over the years as a real estate agent and in my own personal investments, was my primary residence. If you get a primary resident exclusion, if you live there 2 out of the last 5 years, you're not going to pay taxes on the sale of that property. Up to $250,000 if you're single, or $500,000 if you're married. Gentlemen, I've been asked, well, what's a good reason to get married? I think I just found the only one so far. Ladies, I apologize. And number 6, education related expenses. I mentioned it a little bit when I was talking about doing deductions, but because this is one that I rely on heavily, back in 2019, 2020, I was spending a lot of money on coaches. In fact, even last year, I spent $32,000 on one single coach. All of that education is tax deductible. So over the years, I spent over $150,000 in education and just filling my mind with business knowledge and relationships. All of it was tax deductible. So that's $150,000 that I originally paid taxes on, I got to use in my business to grow with, and then I got to take all that money back in tax deductions. Number 7, the rich earn income from investments, not your job. There's a big difference between how you earn income. Active income is taxed on the basis that everybody knows about. Passive income is taxed 10 to 15%. And if you're earning passive income, you don't have to work for it. You can earn a lot more of it because it doesn't involve your time. So the rich earn from assets that are giving them passive income. They're earning from their investments. The poor, the broke, the middle class, well, they work hard, they pay taxes, and they hate the rich, because the rich are making all this money. It's ridiculous how difficult the poor have it, and how unfair it is that the rich have all the money. Here's another option. You can open a solo 401k plan. This is money that you could put into your own 401k. You control it yourself. If you own a business, which I've already mentioned is probably a good idea, if you own a business or a side hustle, you can create your own 401k plan. If you have a corporation, if you're modeled as an S Corp, then you can apply almost $60,000 a year tax-free from any money that you've earned. So if say that you're earning $200,000, $300,000, you can take $60,000 of that, apply it to your 401k, and pay 0 taxes on that money. Number 9, you can defer your income. There's no reason to take income this year. If you had a big gain, but you don't want to pay the taxes on it this year because maybe next year you don't have any idea of what you might earn, or you're pulling down your business and you're slowly decreasing how much your income is, you can defer your income over years. There are multiple different strategies to do this, but one might be selling your business with seller financing, or selling your real estate with seller financing, so that you don't have to pay any taxes in the year that you sold. You only pay taxes on the portion of the principal you receive. Then over the next few years, as you're doing the seller financing, the only income you're going to pay on is interest, which is a form of passive income, not active income, which again, lower tax bracket, much better, more bueno for you, the rich millionaire who is taking advantage of the tax system, which is quite all right. On to number 10. The rich rely on loans. We take out loans against our assets and we live off of the loan money. And as the asset appreciates, we can pay off that loan. As the asset pays cash flow, we can pay off the loan slowly over time. The key is only take out what you need. If you take out an exorbitant amount from an asset or property and you can't pay it back, if the asset's not able to pay that money back, you might be in trouble. But the rich understand this, and so they always borrow less than their assets are paying them. And they make sure that their assets continue to increase that income over the years. Rents go up, prices of products go up, and expenses are reduced at all times. I hope this video was valuable to you. Like, share, subscribe to my channel. Send this to somebody who's mad at the rich and wants to learn how to get rich themselves, or somebody who's already pretty happy with the rich, doesn't mind making money, and wants to get to the next level. I'm on a mission to build 100 millionaires who are inspired to build 100 millionaires. I hope you're one of them. You can click the link below, register today, and I'll take action with you on the next level for building yourself into a millionaire. Take the Millionaire Path survey, and let's find out. What path is it going to take for you to get there? 3 years, 4 years, 5 years before you become a millionaire? Here's my strategy around taxes. Here's what I believe taxes are actually for. They're designed to keep money in the system. So people buy real estate or they build businesses that pay other people. If you take your money out of the system, the government's going to tax you. They're going to take that money away from you and they're going to apply it to some sort of government program. If you leave the money in the system, that means taking out loans, that means buying assets, it means reinvesting, having business expenses or education expenses back into your business, back into yourself. The government's going to leave you alone. They don't want you to pay taxes. What they want is for you to build infrastructure for the country. I hope this makes sense. My name's Walter Monroe, the Real Estate Mentor. I will see you on the next call. Cheers to your success. You have a choice. Always work with the best.